Hi everyone, welcome to this edition of the Profitable Franchise video blog. My name is John Leavitt and I'm a partner at BDO Canada, where we specialize in helping franchises be more profitable and also help them with all of their tax, accounting, and reporting needs. Recently, I was talking to a franchise owner and he said to me, John, I get a balance sheet at every month end and it's got all these numbers in it, but I don't know if my balance sheet is good or not. How do I know if it's a healthy balance sheet or an unhealthy balance sheet? Now, every company's financial statements are different, and there will be items that you need to assess that are specific to your company, but let me share with you 4 things to look at in assessing if your balance sheet is healthy. Here is a typical franchise company balance sheet. Before we start, remember that a balance sheet is a snapshot in time that shows all of the company's assets, liabilities, and shareholders' equity as at a specific date. So it's not like the income statement, which shows the activity over a period of time. The assets and liabilities are both separated into current and long-term categories. Assets are current when they are cash or expected to become cash within a year, and liabilities are current when they are due within a year. At the bottom, we have shareholders' equity, which is your share capital and retained earnings is any profit from the business that you haven't taken out. First, a healthy balance sheet has positive working capital. Working capital is calculated by taking your current assets and then subtracting your current liabilities. This is important because it shows if you have enough current assets to pay your liabilities that are due within 1 year. If your working capital is negative, then you could be in trouble and you'll need to put a plan in place to deal with this shortfall. In this sample balance sheet, there are current assets of $41,000 and current liabilities of $35,000. This gives us a positive working capital of $6,000. Excellent. However, to complete our analysis, we notice that in our current assets, there is an accounts receivable amount of $12,000 and inventory of $13,000. So if these two balances will not become cash in the short term, then the working capital quickly becomes negative. Some people exclude inventory from this calculation for this purpose. Second, a healthy balance sheet has a receivables listing that is not old. Make sure that you are looking at the aged listing of all your accounts receivable on a regular basis and follow up on any of those slow payers. You want to keep your accounts receivable as current as possible. Third, a healthy balance sheet has the right amount of inventory. You want that right balance where you have sufficient inventory on hand to be able to fill all of your upcoming sales, but you don't want to be carrying so much inventory that it won't be used in the near term and have it just be sitting there tying up your cash. Make sure that you are managing your inventory levels to find this right balance. Fourth, a healthy balance sheet has the right financing and at the right rates. One common measure to help check this is the debt to equity ratio, where you take the total liabilities of your company divided by the shareholders' equity. This tells you how dependent on debt your business is. Generally, it's better if this ratio is lower. You want to make sure your repayment schedules match your ability to repay. You want to finance long-term assets with long-term financing and vice versa, and avoid high-rate debt financing such as credit cards whenever you can. There you have it, 4 components of a healthy balance sheet. Thank you very much for listening to this installment of the Profitable Franchise video blog. Please don't hesitate to call or email me if you have any questions or comments, or if we can help you in how you analyze your balance sheet. Stay tuned for my next Profitable Franchise video blog, where I'll talk about cash flow forecasting for the profitable franchise business. Thank you.